Thank you so much for joining us for this conversation. I am so excited to have this exceptional lineup of industry experts here with us. We are going to dive into the minds of young investors, how to attract and retain this group of clients. We are going to talk about social media, technology, the great wealth transfer, and a variety of other topics. But before we get into it, I just wanted to give these exceptional panelists the opportunity to introduce themselves and tell you a little bit more about their backgrounds. Let's start with you, Steph.
Hi, everyone. I'm Steph Guild. I'm head of investment strategy at Robinhood Financial. What that means is I have market views and provide that through education to our customer base in a myriad of ways. And I also contribute to building investment products at Robinhood. Prior to Robinhood, I was at JP Morgan for 21 years.
Lule.
Hello, everybody. My name is Lule de Massé. I have spent most of my career in financial services and made my way closer to either self-directed type of platforms or crypto. My previous role just recently was CEO of eToro USA. I also serve on the board of advisory for a tokenization company called INX, and I'm pleased to be here.
And I'm Sarah Levy. I'm the CEO at Betterment. Betterment, for those who don't know, is a full-service wealth management platform with solutions for retail investors, advisors, and workplace. My background, actually, I've been at Betterment for 4 years, but prior to that was in the media business. And most notably, for those with older children, launched SpongeBob, and for those with younger children, launched Paw Patrol.
So I wanted to start this conversation by clearing something up. We obviously live in the time of meme stocks, day trading, crypto, FOMO, and people often associate young investors with those habits. What are some misconceptions about young investors, and are they savvier than most people might give them credit for? Steph, let's start with you.
She's looking at me. Since Robinhood may be known for investors that invest in meme stocks. I do actually think that they're savvier than they get credit for. We have something called the Robinhood Investor Index, which actually looks at what our customers are investing in. We created an index that allows across all the different account values to kind of contribute to it. And what it shows is that our customer base is very good at establishing long-term positions and then trading around them with the volatility. So yes, some of them are traditionally meme stocks, but a lot of them are the things that we use every single day. They're just the things that like younger people probably use a little bit more than maybe my parents would use. And then they also have a trend of investing in things that they see for the longer term, like AI chip companies, and 20% of the index is in EV stocks, sprinkled around them, not just picking one. So I would say that they are underestimated in many ways. The other thing I would say is that our customer base is about 50% longer term investors and 50% traders. So they're not all just sort of actively trading every day.
Lule, do you agree with that? Are they savvier than people?
Yeah, I do. I think that also the premise of thinking meme stock phenomenon is a flippant one is a dangerous, dismissive thing to do. I mean, as we can see in the election cycle we're in right now, memification is a real thing. And so I do think it also behooves advisors to try to understand, rather than dismiss it, to understand what is happening behind meme stock phenomenon. And I would concur that younger investors, when I was at eToro, our investor base was about 75% millennial, and about 20% of them were younger than millennial. And they would have their holdings really comprised of cash because they wanted to keep their powder dry, ETFs if they wanted to do some sort of like a broad-based basket, and then they would either trade in technology stocks or options, right? So I just want to put that on the table first to make sure people understand they're not one-trick ponies. But I do think there is something to be understood about meme stocks and social and all of the things that come with it, because that is where the voice of the future investor is going to reside. And I think it would behoove us to keep our ears to the ground to understand the why.
I want to high-five you right now.
Okay, I'm going to totally disagree with both of you.
Perfect.
Just because it's more fun, and also because I disagree. I don't think this generation is savvier, and I think that when we survey customers, Betterment's outlook is more about long-term, setting up an emergency fund, diversification, not not over engaging. And I think that what's dangerous for this generation is how much information is available. So I think what's different about this generation is the access to information is totally overwhelming, but most of that information is pretty bad. And I think not unlike other areas of our lives, like politics, where there's infinite information and you don't know what you can and can't believe. I think that is something similar. And one of the things we see when we survey investors is that they are getting some information, for example, from social influencers, and that's dangerous. But what we also hear is that the ones who feel most secure about their future are the ones with financial advisors. And I think we increasingly believe that, like, the DIY phenomenon, while it's here, it's a lot more like gambling. And that is sort of a dangerous path, and the key role that we can play is education that is appropriate education about a long-term outlook, and not get caught up in the meme stocks and the rest of that.
I want you guys to elaborate on this idea of that there's an abundance of information, obviously through social media, that investors have access to now. How is this posing a challenge to the traditional advice industry, and what are you doing to make sure that clients come to you and not just watch a YouTube video or go online to get their investment advice? Lule?
Sure, I love a debate. Oh my God, thank you, Sarah, for starting that. So the one thing I would say, so I used to be an advisor. I started out as an advisor in my career eons ago. And where I would take issue with sort of like looking at the lens of they're lost and too much information, to answer your question, is I think the equipment people need is different from what we used to give them. When I was an advisor, it was about diversify, don't log on all the time or talk to your portfolio manager all the time. Go on with your life. Don't, herky-jerky your portfolio too much. All of these things were about you're okay. It was all about making sure you felt good. That is
Good
not
advice, you mean?
good advice, exactly, good advice. Unfortunately, that is not going to save people in the future because the can's out. It's open. Information is there. Investing is available, very easy available. And so I think what we need to think about when we're advising people is equip them with a compass rather than a net. And they need to be able to navigate the plethora of information. And by the way, I'm an immigrant, and I don't want anybody to get in front of my information. Like, I was an immigrant that came with no money, and because of capital markets and participation in capital markets, I'm able to sit here and potentially have something that I can pass on to my kids. That is the promise of America. And the idea that information has to go back into the can is un-American in my view. What we need to do is make sure that that information has, as I said, people are equipped with a compass. And that's true in investing as it is in general sort of civic life that we're living in. And so I think what I'm seeing among young investors is that they are starting to develop the savvy. Are there ones who are still not savvy? Absolutely. But I'm saying from the seat I have sat in, I'm seeing more of a desire to learn how to use that compass. And that's what we need to encourage.
Yeah, I would agree with that. I think I would not say that they wouldn't benefit from advice. That's not what I'm saying. And in fact, I firmly believe in advice. I also was an advisor at JP Morgan for 11 years. So I firmly agree that they need it. But are they more aware than they ever have been before of certain things that they would not have been able to know about before? I think the one thing we need to make sure is always ensure that they understand to stay skeptical, because a lot of times, like, you'll have a social influencer talking about some aspect, like, contribute to a Roth IRA for your kids and have them work for you. And I'm like, that doesn't work for people who don't have their own business, for example. And so this advice is not personal to them. And so they need to that's just an example, stay skeptical from what they're hearing and saying, like, does it help me? Does it, maybe I should understand this more and read about it more. And actually, that's what we're seeing from the surveys that we do, is that it opens the awareness, but people don't tend to just act on it right away, especially now.
Sarah, did you want to build on that?
No, I mean, I think that fundamentally, I'm trying to disagree, and yet I'm going to agree with the information is available and it's transparent and it shouldn't be filtered. Like, I think that that's all very good, and you can't put that genie back in the bottle. But I also think that some of the tenets that, sort of are tried and true. And the idea of like, what is setting up a good plan and what does that look like and where do you start? Like some of these ideas, I think retirement, is an interesting area to explore because the world really has changed, right? There's no longer a pension fund, for the lion's share, right? Defined contribution plans are 90% of retirement plans. And so what you're seeing is employees who are now, and end clients who fundamentally have to manage much more of their own future wealth, and therefore they need that information, right? And they need good information, and so the access to tools and to 401ks that were once reserved to the wealthy and to people working for big enterprises, like to me that's kind of like where we're headed in terms of thinking about how do you channel the information and direct them to do what's smart for the long term.
Can I build on that?
Absolutely.
So I think that the skepticism is something that's really healthy, and actually that skepticism in my perspective, so if you look back sort of historically, when the '08 crash happened, when the bank crisis happened, an entire generation became cynical. In fact, if you recall, before meme stocks was Zuccotti Park, right? They all went and camped out and said, the 99% was born. An entire generation felt burnt and not left out, right? And that generation, the millennial generation, was who is raising this next generation who also had their cognitive sort of deformation of like skepticism of systems, right? So I actually think they have an abundance of skepticism. And the bad thing, however, is because that skepticism was so deep, it literally made them leave the market. So you saw American household investing go from like 60% down to the low 50s. And now, thankfully, because of companies like Robinhood and eToro and other places, it's coming back up, okay? And so I think what we have to appreciate is that these are not like wide-eyed, naive optimists. They have seen what happens when systems collapse. But I think what there is a feeling that, okay, I can use systems, I can use other things, but I also trust community. So when we do surveys at eToro, when we used to do surveys, we'd ask them, how do you rank who you trust? And the first thing they'd rank is they'd say, number one, I rank my community. Not necessarily social influencers, because that could be one type, but it could be a community that they belong into.
Friends and family.
Friends and family, but also online, right? Like we see a lot of like social sort of investing clubs. And then the second thing they say is, I trust technology, like AI and other things. And then the third thing they say is, I trust an advisor. And I think if we are going to flip that script for this skeptical, do-it-yourselfer generation that is coming up, which I do think they need advisors. I am not saying they don't need advisors. Is we need to change the script of what it is they need as they become the clients that inherit those trillions of dollars of inheritance they're going to get from their parents.
What creates a winning digital experience when people go online or on the app and want to invest, want to get access to information? Sarah, let's start with you.
So we think about technology as a way to save time and money. So we don't think about sort of constant engagement. I'm actually more of the philosophy of a little bit of set it and forget it. I think a winning digital experience for us is saves you on taxes, right? Is tax optimization, is administrative optimization, is again, saving time and saving money are kind of and retention, and ultimately an experience that can help retain customers over time with delight. For sure, you need to be on mobile, and for sure, you need to be mobile first. And I respect incredibly, Steph, what Robinhood has done in that respect, in terms of really understanding that this customer base sort of wants access and wants that transparency. But I think the flip side and the danger of that is too much engagement is not a good thing. And so one of the things that we sort of stay away from, for example, is red and green, right? And this sort of desire, the always-on desire, is something that we try to kind of suppress. And so when we show you performance, we show you over years, not over minutes and over hours, or over days, not over days. So I think you can have technology that helps you automate, and I think automation is really the key. And I think we can talk about AI, because I think that's kind of where it heads, right, for me, which is AI is a continuation of creating power tools that can make humans more efficient. But I don't think what we should seek is technology that engages you constantly, because that drives bad behavior.
Steph, you want to respond to that?
I think, so one thing that somebody said to me a long time ago that I've taken to heart is you don't get extra credit for complexity. And I think that applies to a lot of things in life, including design. So when you design experiences, you want it to be, like you said, delightful, but also simple and easy to use. You can figure it out. You don't have to do like too many taps. And I think having like come from a bank and then gone to a place that only thinks about that, I've learned a ton about how much it matters, the way you kind of like, how can you make it easy for someone to see what they're doing and what their next move should be? I appreciate the long-term view, but I also think like having a perspective of like you should only show long-term numbers means that you're automatically assuming that people can't look at what's happening today and make the right decisions for themselves. And I think that is one of the keys for this generation, is not making an assumption that they don't know what they need to know, that they aren't capable of taking it in and making the right decision for themselves, especially under guidance. So I think that's some of the aspects that we've provided. Another thing that we have done, like we launched retirement accounts. We were very simple platform when we started, and we included retirement is extremely important. We just all said that, we don't have the things that past generations had. And we also know that Social Security is going to start to dwindle, starting, I think, in 2034. So getting people to think about retirement sooner and sooner was extremely important to us, and we put carrot sticks there. So we have a retirement account that provides a match. We were the first. Some people have copied us, but we were the first to do that, and we continue to do it because we think it's so important for people to just do this and think about it and add to it consistently over time. So those are some of my thoughts.
Speaking of retirement, what are some of the fundamental differences in behaviors, in investing behaviors between younger people and older people when it comes to investing for retirement? Lule, maybe we start with you on this one.
So truth be told, I think this is an area where advisors and sort of financial industry could help more with, because I do think we haven't cracked the code for younger generations to sort of have the mental trappings of thinking that's a day that doesn't come and I have to care for now. So even when they're investing, it's more just sort of like, it's a horizon of 1 to 3, right? Whether it's for supplementary income or something else that they're doing it in. Now, what's interesting, however, though, is they do have an intellectual appreciation for tax-deferred structures. So they do know that if they have an IRA, they could trade more in it and not have tax sort of issues that they're going to be dealing with if it's in a taxable account. So I think that that's probably where the key hole is to sort of understand, to teach and learn like what the benefit of a tax-deferred structure is versus being in a taxable account. I do also think that part of, one of the things that I want to build on a little about engagement, I actually think engagement is our friend as advisors, not our enemy. The zealously engaged person is somebody you can channel in different directions. That means they're engaged. That means that they're going to be open to good ideas that are being brought to them. And I think that conventional wisdom is, oh my God, these people are probably shooting themselves in the foot, and so therefore I have to teach them how to not drive the car and be a passenger. I think that that is a mistake with this generation. They definitely want to be the driver. The question, but I don't think that they're dumb enough to think they're going to do it alone. So I think that if there's sort of like a mental shift of thinking you're the co-pilot and not the driver, perhaps for this generation, and empowering that intellectual zeal that they have, there could be ways that we could fill the gap, like an appreciation for retirement, which I do admit is a gap right now for them.
Sarah, do you see that gap as well?
Yeah, I think when I think about retirement, I think there is a bit of a short-term frame. I completely agree with you that that engagement can help us lead them to better outcomes, right? And the inquisitiveness is now broader. You don't have to be as afraid of financial information, right? You see, I think one of the most interesting things actually is communities in this generation who are curious about investing and retirement, like women, more so than the prior generation. So I think it's really an expansion idea. So there were always people asking questions. It's just that group was much narrower than it is today. So for me, that's kind of the interesting opportunity. And again, you know, we're all doing surveys constantly, right, of our different audiences. But I think this idea that there are women now seeking financial advice and there are more women financial advisors stepping up to meet those needs. There are millennials in overwhelming growth mode looking for advisors and trying to help them answer that question really of retirement. And yeah, maybe I know what to do for the next couple of years, but how do I build a plan? And how do I build a plan that's resilient and that's gonna last? And I think there's a huge, huge opportunity to kind of take the information that's out there and bring some sense to it. Your compass, I think, is like a fantastic analogy.
Steph, what has the reception been like to Robinhood's retirement offering, given your clients tend to be younger people?
Yeah, it's been very strong. We had $1 billion in the first year, and then since that time, I think we're at 7 or 8 billion. So it's over 2 years. So it's been a good part of our growth engine, but also extremely helpful for our customer base to think about it earlier and earlier. And the other thing I would say is what we found, to your point about guidance and things like that, is a lot of people were opening accounts, putting cash into it, and then not knowing what to do. So we created a recommendations flow for them at onboarding so they could get a diversified portfolio to start with, and that increased action and funding way more. So people, they do want guidance. Like they just, especially when it comes to retirement, because I think they, similar to previous generations, can be more set it and forget it there. And so that's where I think, they're more like previous generations than in other spaces.
It is obviously a big day tomorrow with the Federal Reserve. Everyone is talking about how Fed Chair Jerome Powell will go up after the interest rate cut tomorrow and, talk about what's next for the Fed. It's obviously been a really unconventional macroeconomic backdrop. We went from near zero rates for a very long time to the highest rates in decades. And investors have felt the whiplash. How have you helped young investors navigate this environment? Sarah.
Sorry.
Sure. So we have both investing and cash on our platform, and this year we added a complement of bond offerings as well. And our view, again, being long-term, is that you shouldn't make kind of rash decisions, but that we should offer kind of a long-term portfolio perspective and the ability to move between asset classes seamlessly. And we've seen over the last year a tremendous amount of interest, obviously, in cash because we have a high-yield cash account. We've now started to see some of that money move more to bonds. And our view is provide advice for our for customers that says wherever you're comfortable, if you're taking a long view, over the long view, you should be invested sort of across the spectrum, and we're going to offer all three, and depending on your risk tolerance and your time horizon, that dictates sort of where we recommend you put your money.
Lule?
I have to admit, when, was it 2021 came, I had to sort of hold my breath because I was scared that the retail investor was going to get scared and walk off. Because I felt like, I saw what happened in '08, right, to the millennial generation, and I was like, oh, it's going to happen again to this generation. And it didn't happen. So I look at it this way. If we are able to sustain retail investors in this environment with our foot, somebody's, having an interest rate environment that's really tough for them, I think that when we 50 is my favorite number now, so I'm hoping that the gods say 50 tomorrow.
Oh, you and I are disagreeing
but
on that.
I do think that in an environment where you have rates going normalizing, it's going to get better. But in terms of how we helped them during the time, it was things like making sure we gave them contextual insights. Callie Cox actually used to work with me, and she was phenomenal at providing her generation that spoke to her about like how to understand this macroeconomic environment and then how to tie that into what you do with your money. We used to have making sure that we recognized that we needed a high interest rate account, so we added those. Interestingly enough, as you know, futures and options accelerated after COVID and stayed accelerated. So risk on was something they really wanted to do. So we offered options as well. So it was both a sort of like answering the cash interest capability, the macro insights and guidance capability, as well as making sure we gave them the risk on assets that they wanted, whether that was in the form of crypto or options.
Steph?
Yeah, not too dissimilar. For the record, 25 in my book. But I would say, yeah, we did the same thing. We offered high cash yields, so that's the flip side of higher interest rates. We actually actively lowered our margin rates, which probably cut into our profits, but it was something we wanted to do. And then also just a lot of education on what does this mean? How does it impact you personally day to day? But then also what is the relationship between interest rates and stock valuations? I have a blog and I write about this all the time. So it was, we actually also started a YouTube channel that talks about the markets every Friday to wrap up the week. So we're trying to get to our customers in multiple ways to educate them.
We mentioned the great wealth transfer earlier in this conversation. I believe it's something like $84 trillion in assets is poised to move from the silent generation, from baby boomers to millennials and Gen Z investors in the next 20 years. How are your firms, and how should firms in general, prepare for this influx of inheritance to younger people? Sarah, let's start with you on this one.
I mean, I think that's a really long-term question. I think we talk a lot about it as though it's around the corner, and the money is still largely with boomers and hasn't even made it to Gen X. So when you think about millennials, to me, we think about it as a relationship. When I think about sort of the longest relationships in my life, I have my husband and then I have my financial advisor. And so to me, that's, and I'm closer to one, but both have been really long term.
The financial advisor, right?
Yes, exactly. No, but I think that's a really important point, which is the great wealth transfer, through our eyes, is really about building these relationships before the customers necessarily have the wealth that you would consider your low bar, because when that wealth transfer comes, they're not going to leave you because you've built that relationship. And so I think the way to think about it is more about what does the millennial want today, and let me solve their needs today, because if I can help them save for their home and put away money, for the kids' education, when the great wealth transfer comes, they're going to trust you, and that's nothing new. That withstands the test of time.
Lule?
I wholeheartedly agree. And I would say the one thing I would build on is you had earlier a session with an advisor and somebody who is like a medical consultant and advisor as well. And they were talking about how, it's not at transition that you're going to keep the money and make the case for the money. It's way before that, right? And I would say, to build on what Sarah said, which I agree with, is it is important to be culturally connected to this generation. And so what do I mean by that is sort of like, one of the things you see persistently in this generation, for example, is that they hold crypto, right? No matter how much, I have dozens of nieces and nephews, and they ask me more clever questions about investing than any of their parents do. But they're all in either crypto or tech stocks or follow a social community. And there are some really interesting social communities out there. And so I think the one thing I would say is, like, get yourself into that cultural sort of context. First of all, I think you'll find interesting things you'd pluck out of it for your own practice. But secondly, you start relating to what this next generation is, which is a networked community. They are a networked mindset. And so I think that's the other thing I would add on top of what Sarah said, is like, get into the context of their culture.
Have you ever read a Reddit thread, like gone through and read them? Because I do, and I always learn something. And I've seen the transformation of knowledge in doing it. But we have 24 million customers. The average age is 34. So our customer base is the customer base that's going to receive the wealth. So what we have to do is continue to develop the products that they need over time to retain them. And that, we're doing it. We're launching a bunch of things later this year. Next year, we just launched joint accounts. Like, that's what I'm saying. Our platform was simple before, but we're recognizing more of our customer base is getting married, having partners. So we're doing things to try to retain them and do it in a way that matters to them, that is helpful to them and the way they think.
Sarah, you just mentioned attracting the millennial customer now before this influx of wealth, comes to them. What are some strategies to attract these younger clients?
Well, I think some of the ideas that Lule and Steph introduce around content, content is obviously an incredibly powerful one if you can reach them. I know customer acquisition is incredibly difficult. I do think thinking about lowering your minimum and introducing them to simple diversification and diversified portfolios with a little bit of information on scalable platforms, which is self-serving for sure, but is also, I think, a really great practice to start to build those relationships with the next generation, whether that's your clients' kids or whether that's hiring younger advisors into your practice to then reach out and have that cultural connection. But I think those are some of the easiest touch points, and to just get them started with good behavior young, and that will breed good behavior and long-term relationships.
Lule?
What was the question again?
What strategies do you employ to attract those millennial clients right now before they do inherit wealth from?
Yeah, one of the reasons I left traditional finance is because I realized the best acquisition of younger investors is to work or found a company that has younger investors as most of their customers. They are a generation that works with word of mouth, cultural connection, and everything else, right? And so I think one of the ways to do it is to invest in a community of younger clients that you have that really can be sort of testimonial to your services and what you do. And again, being connected to that culture, I think, will make sense, depending on the size of your practice. But I do think that reaching younger investors, one is the practical sort of products and services and ease of use and all these things which are already commodities for the most part, right? And the second is how connected they feel to the cultural sort of bedrock that you're creating. And I think that's probably one of the best ways you can also acquire them.
Steph, you want to build on that?
Yeah, we're just a little bit... another tactic that we're taking is we had, I think it was earlier this year, we had our first in-person event, and we're launching planning another one for October, where we're inviting a large group of customers to come to it. And that's kind of building on that, creating a culture. And it's not digital, obviously, but it starts to set the tone of we want to relate to you in a way that is just beyond what's in the mobile app. And I think that matters. I also think staying sort of as skeptical as they are. One thing I used to do all the time as an advisor is the negative sell. Don't do business with me. I swear that created so much trust so quickly. And so almost saying we're probably come back, or let me keep you updated, but we shouldn't work together yet because you shouldn't pay these fees, or you shouldn't do this or that. So those are, I think, having that kind of skeptical approach that is similar to them can actually endear them to you more quickly.
I'm going to ask one more question before I open the floor up to you guys to ask questions, but what role do you see artificial intelligence playing in your industry? How do you see it disrupting the traditional way of doing things? Lule, let's start with you on this one.
Yeah. So I think it's going to be highly disruptive, but very valuable in two ways. So the disruptive part is, I think everybody understands that things that I could easily ask, Google or that I could easily sort of decipher, those are going to be commoditized further. So I would say that's one thing that it'll disrupt, is sort of what we used to think as information transfer at the higher order, that also is going to be gobbled up with AI, right? The second thing I'd say, the benefit of it is it could actually power up the really talented advisor, because if you are investing in things like cultural connection points, empowering these people to be the drivers and you the co-pilot, right? These things, if you get these moments right, then all the things that may be commoditized in the future, what you're doing now, become things that you're easily sort of welcoming it being brushed away, because you can focus on expanding your practice through those means. I also think, what's going to be interesting is as information becomes easy to sort of synthesize, right? Because right now we're all like overwhelmed by information, and I think AI is going to make synthesis of information very easy. I actually think risk-on strategies will increase even more because it's less overwhelming.
Yeah.
So I think both things are going to happen.
Very interesting.
I agree with a lot of that. I think fundamentally AI is going to just supercharge humans, right? Make us better, stronger, faster. And we're already deploying AI in all sorts of ways on our platform. But we see it really as the continuation of an automation journey that we've been on. And so, for example, customer service, para-planning, marketing and creating content, all of these things, whether it's first drafts of CRM materials, whether it's para-planning, summaries and synthesis of information is incredible. And I think don't be afraid of it. To me, would be the one soundbite I would go with, which is I don't believe that AI is going to replace humans. I think people who don't understand AI are the ones who are going to get replaced, and people who embrace it are going to be supercharged by it.
Steph, you share that view?
Yes, generally, but I will admit I'm a little scared of AI because I've seen it. So we recently bought a platform called Pluto that is AI based, and I'm just thinking kind of playing with it internally, and we don't have it out in the wild right now because we're figuring kind of building on it, but I get a little nervous about it giving investment recommendations in a way that is, certainly 100% appropriate for the person using it. And that's definitely where I think AI will end up heading in a more brokerage sense. But it makes me a little nervous because it is powerful and it can synthesize a lot of data at one time, take a look across, for example, call options across all the expiries, but it makes me nervous that it could do that, or there will be platforms that it could do that. So we just have to be mindful of the safety of it. But it certainly is going to make us more efficient. And we are also using it in a multitude of ways for the things that were already addressed.
What a transformative time. I see some really great questions here on the screen from the audience. Let's start with the first. How do you think the rise of sustainable and ethical investing is influencing the financial decisions of the next generation? Sarah, perhaps?
I mean, it's super important. We offer socially responsible investing portfolios on the platform, and the adoption is incredibly strong. I mean, this is a generation that wants to invest with their values and with their hearts, and you can do that while maintaining a balanced and diversified portfolio. So I think it's an enormously important part of, the future.
Yeah, I mean, I think this actually can bring us back to the topic of meme stocks, right? So one of the things you see of the stocks that benefited from meme stock phenomenon is they're connecting. So why did meme stocks begin in the first place? Many, many reasons, but also because people felt like they could express their social point of view on something. You're not going to take away this company that's been a formation
$1
of
was
my-
a vote.
Yeah. So therefore, I'm going to. But then the second part of it is those companies were savvy enough. Again, I'm not a proponent of their underlying value, to also engage those participants in ownership of their stocks, right? So I do think that there's this sort of symbiosis, which is actually kind of old school when you think about it. Like in the old days, at the turn of the century, when people would go to their stockholders meetings and they were like farmers, right? I think that that's actually going to come back, where people are more engaged as owners of a company, and because they are humans, therefore, their views around their social issues then make their way into that, right? So sustainability and ethical investing is one of those. But it could be many other things. As our social ecosystem changes, I think the mechanics of voting through your shareholder voice, I think, is going to keep growing.
Steph.
Yeah, I think that we absolutely see that. There is one thing though, I don't know if it's like the difference in wealth levels or what, but when I was at JP, I probably shouldn't keep talking about competitors, but when I was at a very large private bank platform, I saw that like a lot of the younger generation of the very wealthy customers I had really cared about this. And this is all we talked about was sustainable investing and investing for the environment. But I don't see that as like a top theme whenever we survey, when I look at the Robinhood Investor Index and all I don't see that as a top theme. And so I'm always a little bit like, maybe it's like once you have money, you can afford to care about it. But when you're trying to build your money, you just care about making money. I don't know if that's like a difference, but that's just a theme that I saw.
I think we have time for one more quick question. What key behaviors and habits have you noticed among young investors that set them apart from previous generation? I know we spoke about this on the topic of retirement, but perhaps if you could answer that a little bit more broadly. Steph, do you want to begin?
I'm just reading it again. What key behavior and habits I've noticed among you? So I actually have a fundamental view that the behaviors are, I put this in two ways. And what they invest in, I'd say if previous generations were young today, this is what they would invest in. I see like, you use your phone to do everything. Like Apple is practically a utility company now. So I think that's like the perspective is different. Warren Buffett like took a long time to decide to invest in Apple, and he'd rather invest in like See's candies. I don't think young people eat See's candy. I don't know. Maybe I shouldn't make that generalization. But my point is that like I see the behaviors are different in such that like what we've talked about before, where like they have a lot of opinions and they actually want to learn more on their own and they want to know more about it and not just like give it away and not give it away, but give it to someone else and not think about it. They want to know what's going on. They're skeptical. And so those are the things that drive their behavior. But I don't actually think the investments they're making are any different for their generation.
Lule?
I think one is definitely the skepticism and sort of irreverence. I think the world has gotten so much flatter, and they could probably do what some, old school money manager used to do 20, 30 years ago just because he had more information, right? So there's an element of sort of skepticism and I can do this too element, and I don't think that that's something that you're going to convince them out of. As I said, I think you have to embrace that. The second thing I see is, as I said, they were formed by a post-08 world, right? And so there is a healthy amount of sort of like, it's not just skepticism, but also just sort of like, they know when they're supposed to get a little bit more conservative. Like, when you look at the top holdings on any platform that I've, whether it was TD Ameritrade, eToro, or Ally, cash was a significant holding of people. So they're not necessarily sort of like imprudent. And then the last thing I'd say is they are highly community networked. And that is incredibly important to understand what that means if you want to be able to have them as customers.
And Sarah, and we have about
I guess I would say two things. I would say personalization, and that's enabled by technology, right? So the traditional 60-40 portfolio, there's just a lot more interest, whether that's socially responsible investing, whether that's innovative technology. And then I think chasing innovation, we see more, right? Which is they know what they know, to the point about Apple as a utility. They know what they know, and they want to be there, and they want to be invested in that because they see that as the future.
Steph, Lule, Sarah, thank you so much for such an insightful conversation. Please give our esteemed panelists a round of applause. Thank you, everyone, for attending.